Hey Dan, I wanted to set this to video so that you could refer back to it from time to time to help you better manage your company. First, let's take stock in what you've accomplished. Starting with $0 in your imagination to build a $5 million revenue company is a feat that very few people have accomplished. It is the hardest part, getting up and going. What I want to do is discuss with you the building blocks to manage any for-profit company. And let me specifically say, any for-profit company of any size, you need to have $3 million and more to effectively start to utilize these tools. But specifically, these tools need to be in place when expanding from $5 million to $10 million. These building blocks cover the elements that you're now running into that stop growth in its tracks. This is not any individual tool, but an opportunity to visualize the whole picture, how they systemically work together to address the issues that you're now encountering. Otherwise, it's like whack-a-mole. You're just hitting one problem after the other, and it feels like it's out of control. So, as you grow from $5 million to $10 million, you need to have laid the proper foundation. I know right now that you're concerned with survival. Know that I've engaged companies from $25 million to $50 million where the money comes in and goes out, and they're in no better shape than you. Without capturing profitability, a reversal of revenue is frightening, and it forces you to retrench. As I lay out these tools in this video, we will detail the first five in advance. Any MBA has seen these tools. And consider it like a bag of golf clubs. We're simply going to pull out each club, take a look at it, see how it swings, if you will. And if we get 5% more distance with less effort, it adds up on a scorecard. This is not a risky integration, nor is it anything beyond grade school math. There's some systemic setup required, to get off on the right footing. Let me give it some historical perspective before we start. These tools are tried and true for any for-profit company. It's not some quirky exercise or newfangled thing. Going back 70 years, when the World War II GIs came home, they started building toasters and refrigerators and washing machines and ovens. And those that did not have their act together couldn't compete with GE or Whirlpool. So they went broke, or if they were lucky, they sold out. So along came a guy that figured out how to look at it differently, and he developed a consulting company and implementing these tools thousands of times. So my experience in getting training, in the first 20 companies I engaged, I could really see the systemic nature of all of the clubs in the bag, just how its integration works. So again, it's not one specific tool. I simply organized so that I could enter the next companies. From there I engaged many companies and really able to do it, integrating with as little drama as possible. And let me quickly add, you once mentioned about getting more formal education to run your business. That would distract you from the tasks that you have at hand. It's counterproductive now that you're underway. This is the most direct application to pursue your concerns. While there always will be plenty for you to learn, you must apply your time to the business and learn as you go for the rest of your journey. I will contradict this with one comment that once you have your hands around this, to take a managerial accounting course for a deeper dive into the income statement and balance sheet. That will serve you well for all your future. Let's first take a look and understand profitability in a new light. In my past experience in stepping into XYZ company as is, I usually find that they were making a 5% net income. As you know, in your income statement, you have your sales, your cost of goods sold, gross margin, sales and administration, and a net income. This graph is intended to really look at your fixed and your variable costs. So think about it. You might have fixed costs in the salaries for some managerial staff, but you might have some variable costs that are maybe a piecemeal for assembly that, in your income statement, they might come under your sales administration, but it really is a variable cost. So this is looking at your fixed and your variable costs. So this graph is intended to look at year end, so it's a little bit distorted, where if we're a $10 million company, we've got over $3 million in fixed costs. and we've drawn a straight line throughout the year as to this is the fixed cost we intend to spend by the end of the year. Now normally you'd have your rent and your utilities paid month by month, and that would stack up. So we've distorted it by saying there's my fixed costs at the end of the year. My variable costs, as I sell every next widget, continue to grow throughout the year so that I get to my variable costs. And my sales are one fixed number. Of course, I might have some seasonality in sales, but when I have one fixed number, I draw a straight line from 0 to 100% in sales. So you can see that in my fixed costs and my variable costs, I have $9.5 million of expenses and $500,000 in net income. My break even happens sometime in mid-October, and you can see that each incremental sales contributes to my net income, which at this point it's pretty slim. It doesn't take a lot to reverse those sales. So I really need to capture my understanding in month 1 and month 2 how the year is going to play out. So if I need to start paring down on my fixed costs early, I'm really running 6 and 12 months in advance at all times and controlling my fixed costs against what my overall sales is going to be. So this is really about setting up the cart before the horse and having the full integration before the first month to really do everything possible to capture 10%. But let's take a look at 10% for a moment. So after you've applied the effort, this is really what you're targeting for. Again, $1 million in profitability and $9 million in expenses. Still not fun. And in a competitive world, it is hard to maintain 10%. You can be pushed down to 8 and 6. But at least you're targeting for that $1 million in net income as you start. So same rules apply. I've set my fixed costs. I've got my variable costs stacking into it and my sales. But now, as I'm getting to break even in September sometime, I've got more time to capture more profitability at this point, and I'm also really understanding month 1, month 2, month 3 as I progress to year end. So with implied intention, every $10 million in sales provides another $500,000 to net income year after year. All right, let's get looking at the tools we're talking about. This is, you've got an existing company, you've got some sales, you've got some advertising in place, you've got some operations, workflow and quality assurance, and what are you trying to accomplish? Goals of the company: to be profitable, to have fiscal control, delegated responsibility, accountability, and employee motivation. I observe that 3 out of the 5 of those are really on your organizational side, but what we're doing first is going through for our fiscal control and reporting systems by these specific tools here on the left-hand side. A balance sheet is really a quick analysis if you're bankrupt and can't salvage anything. We'll talk about cash flow analysis in this video. Typically, you would then run into a accounts receivable, accounts payable to quickly generate cash by pushing on those two. But we're going to bypass that right now to look at the chart of accounts, the statement format, the trend analysis, and a fiscal budget. Without any more real discussion, let's just dig into each one of those and then we'll come back and visit this full layout. So, cash flow analysis. I want you to look at cash flow in 3 different scenarios. Picture this first one, that you're a 75-year-old man and all your kids are out of the house, and you've been running this company the same for the last 10 years, and you're not making any changes, you're just living off of the income. So you know very well that, your sales, your cost of goods sold, your administration, let's just say back to my $10 million company, I'm going to have 7 million cost of goods sold, 3 million in a gross margin, 2 million in sales, and 1 million in profitability that I'm going to take home each year. That's it. So you don't really have to think about cash flow. You just have to know all your math is in place. And once my sales are taking place in this region of $10 million, I don't really have to think about it. All my employees know what to do. All my suppliers are the same suppliers. That is where I want you to get to in terms of profitability. Now, we're going to jump back a little bit. The second level is I want you to look at profitability for the year. This just happens to be a 13-month cash flow. It just allows you to look at profitability for the year. Let's just quickly look at the mechanics. I have a bunch of payable, rent, payroll that I can throw out for the year, and I can surmise, what that's going to be. Notice my $1 up here. I'll explain that in a minute. But there's all my payables on this page. Here's all my receivables on this page. And now it all trues up here. My $1, I start with $1 of cash in the bank. I have $1 of accounts receivable. Therefore, I have $2 this month, and I have $1 in accounts payable that rolls forward. So I can see by my $1 here throughout each month that all my math is correct in terms of my calculations before I start plugging in this calculator. But the point is, this is all going to roll up. And then I can make decisions like, look, I want to buy 4 new machines, and I'm going to have certain expenses in these first months. And then I can look at my cash line here, and I can start plugging in additional cash that's going to come in over this time period so that I get a good understanding as to what is my bottom line doing here. And I might say to myself, look, in 6 months from now, I've got to go out and get some financing or whatever you have to do, but it allows you to shape your plans for the month. And this isn't bad as you're growing the company and doing the things you want to do. This is my 13-week cash flow, and this is when you're in trouble. It's the same payables, receivables, adding up to the cash flow. But this really boils down to now, I can plug in here my scenarios when I start robbing Peter and paying Paul, and I'm struggling week by week now so that I get out to 4 or 5 weeks from now and I can see that I'm in trouble. At least it gives me time to go after it and correct these problems. You don't want to be here. You want to grow out of this as fast as you can. It is just painful, but sometimes necessary, when you really have to make decisions. Staying in touch with your suppliers, communicating, being able to commit what you can do. And this is where you have to figure all of that out. I'll say real quick, 20 years ago, I was in with a guy. He had about $22 million in revenue, and I did a cash flow for him. Went home, everything was fine, nothing wrong with the cash flow. He came in the next day and said, "Hey, I slept last night." And I was like, "Well, what do you mean?" He said, "For 25 years of running my company, I knew I could get through this week. I had enough cash in the bank. But the second week, I knew I could juggle to get through that second week, but I never knew if the third week the bills were going to come in and sweep me under." And so you never really know what a business owner is thinking. And this is how you want to get control of these kind of things and understand your decision making with it down on paper so that you can understand and make commitments and meet your commitments. All right, let's move on to setting up the chart of accounts. This is the formal creation of your income statement. Doing so in a manner that you can repeatedly capture the costs in the right category so that you can monitor those costs against sales. This is a truck stop with a restaurant, convenience store, and fuel. And you can see that the cost of goods sold is then broken out. The income of the restaurant is food, beverages, and other. The expenses are then broken out against food, beverages, and other, and supplies. Then the wages associated and then the uniforms and the cleaning, so that I can look at food to food. I can look at the entire revenue of the burger stand against the entire expense or the variable expenses of that restaurant. And so goes for the convenience store, for the fuel. And you can see that maybe for the restaurant I have a manager. Therefore, that would be covered in my fixed expenses or wages and payroll of a management that I'm going to pay for the year no matter what, in contrast to the other employees that work underneath as variable. Let's just think more an expendable. If I have greater revenue, I'm going to hire more employees under that manager. And if I have a fall off, early, I am letting go of those employees, be that part-time or however you handle it. And essentially trying to create what is a variable and a fixed expenses in the company. Notice these, trying to highlight them as semi-variable is, kind of a ridiculous exercise. But in some ways, if, times run tighter, these are the areas that I can cut back versus my fixed expenses, theoretically are set for the year. This is, I know, not what you bargained for in terms of opening a business, but getting your hands on this early, setting up the structure so that you can compare year after year and truly monitor your expenses is an essential part of running a business for the long run. So once I have that chart of accounts set up properly, I can then look at over multiple periods and have all of my costs, associated into the right buckets where I can then do solid comparisons. This is the same truck stop with the revenue and expenses laid out in the same format, and this is year 1, year 2, and year 3. In actuality, this was the same year, but this was, of a 3/4 of the year. So this is a 3-month period, a 3-month period, and a 3-month period in actuality. This is a simple exercise to take all of the sales at 100%, and then multiplying out what percentage, for example, this line item, restaurant food costs, is as a percentage of total sales. I'm going through an exercise where I look at the 3 years and I can say that, this year it costs 10.35%. This year the food costs 8.47%, and this one 7.96%. Now this is the most current period, so you can see of these 3 numbers, the percentage is the lowest. So in effect, I cannot improve this number, but I'm really picking which percentage is the lowest percentage. I then take my final year of sales and I carry that forward, and I multiply out all of those lowest percentages against the revenue to see what is the leanest that I can run this business. So if I really look down here, and here I might be able to save $8,000 over a year. Okay, $1,000 is not very much, but I get down to this fuel cost. So let's take a look at fuel against all of my revenue is 30%. It's grown to 33, 34%, and now 36%. That fuel, there's something going on here for me to chase down and to understand. If I look at these 3 percentages, my best percentages is 30% against my overall sales. And here's where effectively I'm chasing after that I have a hole in my pocket, funds are leaking out, and this is the area that I have to go and correct. What typically happens in doing this exercise is I might have some large standout, but then I might have $15,000 here, $12,000 here, $22,000 here, and it gets down to $1,000 and you go, oh, forget it. I can't do all the effort to chase that down. But this is where I'm looking, how to know where to look at that I'm losing money, and now how to align what is the leanest I can operate this company. And that if I take it all the way down to my expenses, I should be easily saving $83,000. In this case, it's a quarter So, I mean, multiply times 4, and it's worth systemically chasing after this effort to get after my profitability. Mindful, this was about 20 years ago, so it was a serious amount of money to, squeeze out profitability. Again, this is a best case scenario, but that's where I get my indications and how to monitor when expenses are getting out of control by this trend analysis. So from the trend analysis, I bring forward the least cost of operations, and I put that into my annual projected numbers. This happens to be a roofing company with a set of revenue and its expenses. So I bring those numbers forward. Of course, I make any changes if I'm going to expand or make investment and what have you, to represent the best of my ability now of what this is going to be projected on an annual basis. And from there, I might take my revenue and break it out evenly, or I might break it out seasonality, guessing what that total is going to be at the end, but what it might be throughout the different seasons. And the same with the expenses, break those out accordingly. And now as I go month by month in my budget, I am able to see very early on, month 1, month 2, month 3, that I'm going to be able to meet my goals in the end, be that revenue, be that expenses. So essentially, I'm constantly at every moment in time running my business 6 months to 12 months in advance and adjusting so that if I have more sales, I can deal with the investment appropriate to meet those sales, and at the same time I have less sales, I can cut back well in advance rather than waiting till after the fact, and adding up the chips at the end of the year, if you will, to see if I'm going to have a profitable year or not. So let's review what we've accomplished. We've looked at how to look at cash flow in terms of getting through the day-to-day. Then we've looked at the long-term systemic setup, where we covered the chart of accounts so that they're in their proper format, that statement format so that I can see my fixed and variable costs. Then I can look at the trend analysis to see the areas of the company that I need to focus on. I've also made an assessment of how lean I can run the company. And with those lean numbers, I've moved forward into a fiscal budget, which this lays the groundwork here of me managing my company for profitability. We'll step on to the next tools to understand what a flexible budget is about, variance analysis, kind of a break-even analysis. Again, I think your current concern is with inventory control. We can go straight to and skip down and address inventory control, for example. But in effect, you want to look through and understand each one of these financial tools. And as we get through to the end, this will help your daily managing the company that systemically leads up to the year and allows you to personally focus the company and your employees towards profitability. And I just figured we'd cut this video off right now and step forward into the next video as we move forward. Dan, I hope that was entertaining to say the least, but hopefully enlightening as to the initial steps in getting this up and getting this in control. I thought what I'd do is have you watch the video, and then if you would take a notepad, just write down questions as it goes along, and then we just do a follow-up session, and I try to answer those questions that would make sense. And then again at the same time I'll get on with another video and try to systemically step through these just as quickly as I can and not belabor any point to make it so that it is just easily to digest what it is, and then to a certain degree give you the tools to hit any one of those elements just as quickly as you can. I hope you're doing well.